Hi, and welcome to the Presidio Group's Drive-In Live series. I'm Jason Stein, Managing Director at Presidio, and I'm joined again today by Kevin Tynan, our Director of Research. Great to be with you, Kevin.
Hey, good to see you again.
We're once again very happy to spend the next 30 minutes in front of an audience filled with senior leaders, decision makers, and executives from across the automotive space. As always, we're excited to provide a unique perspective on the earliest release of dealership operating data in the auto industry, delivered through Presidio's exclusive partnership with NCM Associates and representing more than 4,000 dealers across the U.S. Now, that partnership gives us what we believe is the most robust, timely, and comprehensive read on dealership performance anywhere in the market. More importantly, it gives us something beyond just data. It gives us early signals and a view into how this industry is actually performing right now. And how is it performing? Well, here's the quick takeaway, Kevin. New vehicle sales and dealer profitability are both down for the quarter against a difficult comparison to Q1 of 2025. Both new and used margins continue to be under pressure. F&I continues to be a bright spot, offsetting some of the decline in vehicle margins. And most notably, fixed operations growth has appeared to slow compared to the past several years. After a 2025 that was benefited by changes in government policy, we are now entering an organic market that is seeking a true balance of supply as well as demand. So the question is, what does it mean for dealers? Is the industry entering a more sustained period of earnings pressure? Lots to discuss. Now, we're going to spend the next 15 minutes on data as well as our own perspective, and then we're going to move to your questions for the final 15. You could submit questions, as always, at any time by clicking on the Engage button at the top right of your screen. And you can access our full report at thepresidiogroup.com and watch this session on demand through your Presidio Leader Pass login. So with that, Kevin, let's get to the big picture. Coming out of Q4, we talked about stability. Now we have 2 consecutive quarters of declining profits. Q1 net profit declined 11.2% year over year against a very tough comparison, as I said earlier, when March of last year marked the highest new vehicle revenue month in history. So Kevin, we'll start off with what changed, and are we now in a different earnings environment for dealers?
Yeah, and look, March was unprecedented, right? Record revenue. But the thing about that, and we talked about this before, is that it was about getting deals done from the consumer's perspective. It wasn't stimulus that lowered prices and got, the consumer in on that attraction. It was, let's get this done before prices rise due to tariffs. And really what we saw this year was the payback from that. So the year-over-year comparisons really weren't that bad in January and February. When you get to March, it was this blowout month a year ago, and there's that payback. It just
It's tough to line up against that.
Yeah. And especially when it's that kind of stimulus. It wasn't just automakers dropping prices and dealers giving up margin. It was sort of the best of both from the OEM's perspective, which is we got volume and we had firm pricing. And that comparison becomes almost impossible.
Let's go one layer deeper. New vehicle sales declined 8.9% overall, with all brand segments down and luxury brands down 12%, again, against a difficult comparison to last year. At the same time, margins declined across all segments. So dealers are getting hit kind of on both axes, right? Volume and margin. What's your overall read there?
Right, because again, you had both in the previous year ago quarter, right? You had volume and you had margin because the consumer wasn't as concerned about pricing. And in terms of the volume drops across the segments, it makes sense. You have luxury, big European presence there, which was where the tariff impact was really going to be felt in the second half of last year. So the same thing for the domestics. When you look at them, a lot of production in the US, not as much of a tariff threat. So when you cycle through to this year's first quarter, that hit probably isn't going to be as great. But the one thing, the takeaway I get from that is, and look, this is one of the dealers' business segments, the new vehicle market. And in my opinion, it's acting rationally. We had stimulus, we had this pull forward, and now we're paying for it, right? And that's just the way you'd rather see the market working in the right way. That
I mentioned it at the outset. It is settling into that more of a, we hate using this word, but it is that normal, right? It's not fueled by anything on either end.
Right.
It's organic.
Right. And even though it's not fueled by anything this year, it's the comparison to last year. So if we can get everybody to stay out of it, and we will get a more normal or organic kind of market. And you can get a better gauge of pricing power, margin, the cycling of that profitability from new and used to other business units, and really see how the industry as a whole over a longer period is actually performing.
True footing, if you will.
Sure.
We also saw net profit decline across every segment. Luxury down 14%, imports down 12%, domestics down 8%. Domestics held up slightly better, but still declined, obviously. Is that relative outperformance meaningful, or just a timing lag in how the cycle is hitting different segments?
Yeah, I think it's exactly that. And again, you had the stimulus from last year was very specific on some groups more than others. And that plays out a year later when you go up against those comparisons. So again, rational, if not efficient, at least rational. And we might not always like how that rationalization plays out, but it's just how the market works, and it's working.
Let's shift to used. Used vehicles tell a more nuanced story, if you will. Sales were relatively stable, but margins remained under pressure due to a elevated wholesale pricing market. Help us reconcile a certain dynamic. In new vehicles, tight supply historically boosted margins. In used vehicles, tight supply is increasing acquisition costs and compressing margins. What's going on there? Explain to me what's happening.
On the wholesale or the acquisition side, you're dealing with much more of an auction, if you will, right? So new vehicle, you are a franchise dealer representing a brand. You're getting that brand's products. There's not that bidding war for that vehicle that you would have on the used side. So you're dealing with much greater competition to acquire those vehicles. The other thing that you have in the used vehicle segment that you don't have in the new vehicle segment are two very large players that are pure play used, Carvana and CarMax. So now you throw those two 800-pound gorillas into the room, and they're bidding up because they need inventory, right? There's no other business for them. There's no fixed ops. F&I is a much smaller component, and there's no new. So when they need inventory, being willing to overpay elevates the entire wholesale value, including for the private seller. So now the private seller wants to trade something in, and they just can go online and see what Carvana or CarMax is going to offer them, and that puts pressure on the individual dealer on the ground to bid up for that vehicle as well.
1,600 pounds of gorilla in the room. F&I continues to be a stabilizer, supporting front-end profitability, but it's increasingly doing more of the heavy lifting. Are we approaching a ceiling on F&I contribution per unit, or is there still some room in there for growth?
I think there's room for growth, and I think that's sort of what this industry is from the retail perspective. For businesses, F&I and fixed ops are the earnings drivers and really always have been. And I think we're coming out of this period where new and used, especially new vehicle market, got all the attention, right? Front end gross was record. It was inventory didn't sit for more than half a day, and it sold over MSRP, and we saw these great margins. We're just cycling back to the way this industry has worked historically, and that's dependence on F&I and fixed ops, which in my view is actually a good thing, right? So the headlines go to new and used vehicle, right? There's the visibility and there's the story. Everybody knows those names and the brands, and they drive those products. But really, this is better, healthier for the industry, for the franchise dealer to have earnings being driven by those two business units.
Let's talk about what may be the most important development this quarter, fixed operations. For years, it's been the industry's most reliable growth engine. In Q1, though, fixed ops grew just 1.4% overall. Is that just temporarily slow growth, or are we starting to see some structural pressure in the fixed ops business?
I think it's a timing issue, right? And the way I look at it is that when you have the interplay of those business units, and the way I phrase it is repair versus replace. We're coming out of a period of replace. We did a 16.3 million unit new vehicle market in 2025. So to me, that's a replace market, right? People bought new. And I think as we start to see volumes come down a little bit of pricing and margin pressure, you're going to see the more of the repair, right? We're seeing loan values extend, terms extend to longer. So it tells me that the consumer is probably going to drive, run what you brung for a little bit, and you're going to repair what you have. And I think that's just, we haven't gotten there completely yet. We're still coming off that 16.3 replace market. We're going to cycle to the repair market. Throw in the fact that the fleet is larger than ever, it's older than ever, and we're driving more miles than ever. And I think it's just a timing. The underpinnings for the fundamentals of fixed ops are there. We just haven't seen it yet.
So you just said something that I want to just touch on briefly. Let's zoom out to the consumer. We're seeing extended loan terms, higher monthly payments, and increased sensitivity to affordability. How much of this pressure ultimately traces back to the consumer hitting affordability limits?
Well, there's still affordable vehicles out there. We've done the analysis and it's still there. I think there's pressure from other parts, interest rates, household debt, everything is more expensive, inflation. So again, I think that puts me in the mindset that we're going to see a period of repair. Drive what you have. It's new within the last several years. That money will go into fixed ops rather than to the replacement market and the new vehicle market. And again, I think that's healthy, right? These are wider margin businesses for the dealers. And the vehicles are there to be repaired. The franchise base probably has to get a bigger share of the customer pay. The recall business is there as well. We've seen recalls we're not going to see fewer of them, and we're not going to see that population of recalled vehicles decline anytime soon, if ever. So the opportunity is there in fixed ops. I think we just have to cycle into it.
Even as operating performance comes under pressure, the M&A market is telling a different story. What we're seeing in the first quarter is continued strength, arguably even acceleration in that dealership buy-sell activity space. Now at Presidio, we saw a record first quarter in completed transactions, and the pipeline remains at record levels as well. What are you seeing in the M&A market, and is there a pattern there of strong appetite for high-quality assets and I guess luxury top import brands? What's your read?
And there always will be. It's a business that's diversified. It's resilient. There's revenue flexibility. And again, I think if you're going to look at the new vehicle segment and the used vehicle segment and correlate that to the M&A market, it's a mistake. There's opportunity in this business. It's just not coming from the traditional or from the headline segments, but it's there, and the smart operators know it, and the company's looking to grow. The dealer group's looking to grow. There's going to be opportunity, even if it's contrarian.
Let's talk about what's ahead. The industry is about to lap continued tariff-related pull-forward demand in Q2, the expiration of the EV tax credit in Q3. So comparisons are going to be difficult. We're going to talk about a lot of this clearly the rest of the year, especially the next 2 quarters. Do you expect profitability to stabilize the first half, or is there more downside risk as we move through 26?
Yeah, and again, look, April will be to the second quarter as to what March was to the first quarter. It was, a 17.5 seasonally adjusted rate. That's going to be tough comp for the second quarter. And, when I think about profitability, again, I'm seeing it as a cycle. New and used probably going to continue to be difficult, right? Front end gross there on both sides of those are going to be tough. F&I is going to be an opportunity, and I think fixed ops even bigger. So it's not so much that there's this big across the board margin compression. There will be, it'll feel like that, and there will be a little bit of it. But again, I think it's more of the cycle back to what the earnings drivers are, which are fixed ops and F&I. And again, I think that's very healthy. It's what the industry has been based on for a long time, even though it's not what's always talked about.
Just before we get to our questions online here, when we sit down for Q2, what are the 1 or 2 metrics you're going to be watching most closely to determine the health of the automotive market for customers and dealers?
Yeah, look, I'd like to see price stability and new and used vehicle margin, at least stability. What scares me about new and used vehicle margins are we saw this big spike and now we're coming down. What frightens me is that those margins were compressing before the pandemic. If I go back to the post-bankruptcy period when operating profit really returned for the OEMs, for the dealers, since that period, margins have been declining. Then we saw that supply disruption and margins spiked. And now I feel like we're getting back to that trend line before the pandemic, which was not good. It was negative. It was declining year over year since about 2012. What concerns me is that we fall below where that trend line was. I don't think the second quarter specifically will answer that question, but to see some stability in new and used gross margins would be, even if it's, the historical levels of the 5% on new and 6-7% on used, I'd like to see that rather than the perpetual burn that we're seeing in that.
All right, that's Tynan's take. Now let's hear from you. All right, let's get to it, Kevin. First question, how are inventory levels looking as far as supply-demand balance as we get further into the spring selling season? What brands are doing well and what brands might have challenges?
Yeah, so inventory heavier than it was this point last year. I think, though, a big portion of that is the sales part of it. So the way I look at it is this: if we look at where inventory was, number of units to start the second quarter, it's about 3.1 million. I tend to like that number to be 2 times monthly sales or less.
Okay.
So to put that in context, on average in the first quarter, it was about 1.2 million units. So you'd like inventory in that sales environment to be about 2.5 million. We're 3.1. So a little bit light there. Now, keep in mind, January, February, at least in my part of the country, in the Northeast, was brutal in terms of weather.
Right.
January, February. I don't like blaming things on weather, but it was a reality in the first quarter. So 3.1 million units is reasonably consistent. Where we saw inventory look bloated was because we had a 1.3 million units of sales per month. Take that to the year ago, we were only 2.8 million units of inventory and sales averaged a little bit more than 1.3 million. So it was a little bit closer in terms of that balance. I think, and we talked about this, one, the comparison on sales was difficult.
Right.
The other thing was that weather didn't eliminate volume. It just pushed it probably into the second and into the summer selling season. So I would think that those levels of inventory will get closer to 2x at some point during the second quarter. As far as brands, what I would consider manageable inside of 2 months, 60 days, Toyota still very good, Honda in the 50s also, and the one that was somewhat surprising was General Motors, which I calculated at 59 days. So you like to be between 55 and 65. They seem to be right there. The other end of the spectrum, Ford was in the mid-70s, so a little bit heavy, and some of that could be that sales component as they deal with inventory issues on F-150 and aluminum and parts disruption.
Dealers also saying, by the way, anecdotally, that they're getting the wrong product.
Yeah.
They're not getting the product that they really want right now.
Right. So it seems that's showing up in the inventory.
Yep.
The other one is Stellantis is up in the 80s. The CDJR brand's up in the 80s, which is not uncommon lately for them. The one that was a little bit surprising for me in the 70s was Hyundai Kia. So I think that's a manufacturer that's really been making a market share push. To do that, you need to stock up your dealers. And then if you get weather or disruption like we had in the first quarter, that inventory number can look a little bit bloated. I think it looks that way as a snapshot in time. Like I said, as we move through the second quarter into the summer, tax returns, better weather, product available, the consumer just getting out and about, I think those numbers tighten up a little bit.
I saw some inventory numbers too. Volvo was also extremely high, 80s, maybe even low 90s. So something to watch for sure.
Yeah, it's certainly not time to panic yet for any brand. I think the best is yet to come in terms of demand, at least as far as 2026 goes.
All right, some more questions coming in. Is there more risk in increasing PVR and F&I when loan terms are extending so that product cancellations become more likely, impacting future earnings?
Yeah, F&I is difficult. The one thing I always go back to is that the consumer or the U.S. consumer is going to borrow, right? So interest rates get high, things get expensive. The consumer will borrow. Negative equity, right? If you enable them to roll negative equity into the next loan, they will. But it is concerning when you look at delinquencies and the length of the term, loan to asset value, and you look at those metrics, they're a little bit concerning. I don't think it ever causes, if we're a 5 to 16 million unit market, it doesn't knock us to a 12 or a 13. I think it just puts more consumers on the sideline for a little bit longer, and then they become more expensive or difficult to get off that sideline.
What can I do as a dealer in terms of managing parts and service to capture as much of this repair wave that we talked about happening?
Well, look, the one thing I would say is that it's there to be captured, right? Depending who you ask, and there's all kinds of numbers out there in terms of the size of the auto care market. $600 billion by the end of the decade or sooner, and the franchise dealer base might only get 25 to 30% of that. And we talked about it earlier, right? The fleet is larger, it's older, we're driving more, it's there. I don't have the answer for the dealer specifically to say, how do I capture more of it? I will say, though, that it's there and we're cycling back to it. And again, we're talking about getting to a repair market rather than this 16.3 million replace market. And the dealers, we see it, they come in and there's all these issues in the service bay. It's like, hey, why don't you just get a new one, right? I think it's going to be more like, no, I'll pay the money to have this one fixed, and I'm going to keep it a little bit longer because of those previous points, right? Negative equity. I need to pay this thing off and have it start paying me back because it's fully depreciated. So I think we're getting into that cycle, but it's there to be captured for sure.
Follow up on that regarding the expectation of more repairs. How quickly do dealers need to be repositioning their fixed ops capacity to capture that shift? And what does that look like operationally?
Yeah, I think that's a very big deal. We're out and about talking to dealers, and getting techs trained appropriately is going to be a big focus. And I think we're seeing that at every level, right? On the ground at the dealership, getting involved in local education of techs, but also up to, all the way up to the NADA, getting involved with those programs to get techs in the shops, because again, it's there to be captured. And there's definitely room to increase that capacity. Mobile service is another one, right? If you can take some of that service out of the bay, tie up a tech and a lift, and do it at the customer's house or wherever it winds up being done, that's an increase in capacity without adding a whole lot of additional cost.
At what point does continued margin compression become an existential conversation for smaller single-point dealers?
I think margin compression, we're talking about new and used. So a very long time, if not never, right? And I think this is the way the industry has always worked, right? Is that you're not, the new and used vehicle sale isn't really where the profit is, right? There's the revenue's there, but at the end of the day, it's creating a customer, a repeat customer, a service customer, an F&I customer. So the ancillary parts of the business are really what drives it. Does that mean that new and used vehicle gross margin goes to zero? Probably not, never. But it can continue to compress. The good news is that's not the best part of the business, right? It's the most visible part of the business, and it may be the biggest part of the business in terms of revenue, but it's not the best part, right? Fixed ops, F&I, just doing what dealers do in terms of repeat customers. This will be here for a long time.
Yeah, exactly. You've talked before about watching expenses. We've talked about that at length on this program as margins compress. Are dealers doing enough to rein in their costs based on the data that you've seen? You got any red flags out there?
Yeah, look, and we go through some of those expense lines, personnel, labor costs. There's definitely room. I think the other thing too is we see it a lot as far as technology. I don't think that we're really there in seeing the impact of things like AI, which you can't walk 10 feet without somebody talking to you about AI.
I'm going to get to that in a minute, so you can't go anywhere.
In the automotive space. So we're not seeing the impact on the income statement yet, but I think To me, that's the important thing. Front end gross, especially on new and used vehicles, is going to always be difficult, if not increasingly difficult. But that gross profit pool, I feel like the dealer can hold on to more of it by managing those operating expense lines. And the ability to do that is there with the technology, some of it which hasn't even been created yet, some of it which is talked about every day in terms of AI. The opportunity is there to drive operating margin and net margin and not be solely concerned on gross per vehicle or gross profit overall.
All right, you brought up the two letters. I'll bring them up now. What's so much hype about AI in retail auto right now? What parts of the dealership do you think will benefit first and benefit the most from these tools?
And I think it's that, right? I think it's efficiency of the people. And I say that there will be people, right?
Right.
And I also caution not to talk about AI is going to turn you from X number of vehicles per month or year to 3X. I don't think we're anywhere near AI selling vehicles just yet, right? At least not at that level. I think the impact can be felt in efficiency on those operating expense lines. So anybody sitting back waiting for AI to turn their store into 3X the new or used vehicle volume, I don't think that's the reality. I think things like efficiency in scheduling or pricing or credit, valuing a used vehicle, right? There's a lot of repetitive tasks that can be taken over by AI that can make people more efficient. But I think people are going to be the key in this space for a long time.
All right, a lot of uncertainty around some global issues, obviously. Higher gas prices, high oil. What's the right way to manage electric versus gasoline inventory when demand signals for EVs are so uneven?
Again, I still go back to the idea that that's a push market from the manufacturer. So not a pull market from the consumer. So if that is the manufacturer pushing, to me, that's all about profitability. And that's still not there. So there will be product available, not in huge volumes. I don't think gas prices are high enough, long enough to change the real mindset of the gasoline versus electric decision just yet, and probably never will be. I mean, we saw a period when it wasn't a concern, and what happened there, right? We just didn't get the traction in terms of EV adoption. You take away the credit, September of last year, and we see how the market's that segment of the market has fallen out. And I don't think higher gas prices reverse that trend, right? Because it doesn't impact profitability for the OEM at the beginning of the process, which to me is how EVs get adopted.
What do you think is a healthy earnings mix for dealers in a more organic environment as far as contribution from new, used, fix, F&I? And then what's it going to do to valuations? We talked a lot about valuations a little earlier, M&A activity.
Yeah, look, and I feel like, I had just made the chart. Fixed ops, F&I, 72% of the gross profit pool in the fourth quarter of 25. When that new vehicle margin was at its peak, that was closer to 54, 46, and it's gone back the other way. I don't want to see it be 80, 90%, but I think when it needs to drive the business profitability wise, it's there and it can do it. So can it be 75-25? I think it can be, especially if new vehicle and used vehicle growth don't recover. I think they will. Based on the supply-demand balance on the new vehicle side, we'll get some stability in the new margin. And I think that 70 to 75 in fixed ops and F&I, and 20 to 25 or 25 to 30% in vehicle sales, new and used, the combination blended of both.
And valuations on stores, just the second part of that.
And I think earnings are earnings.
Yeah.
Right. So, and like I said, that the way those earnings are generated is now cycling to the way it's really always been. And I think the healthier parts of the business.
Great. Kevin, thank you so much. Thanks to our partners at NCM Associates and to all of you for joining us for Drive-In Live. You can find more insights, podcasts, Full Throttle and all kinds of data at thepresidiogroup.com. Remember, today's session will be available on demand through your Presidio Leader Pass link. Thanks for being with us. We'll see you again next time on Drive In Live.